on location home invest show coming to you from Nashville, Tennessee. I'm staying at the Airbnb right now. That's what's all this stuff on the background. But here's what we're talking about today. Will builders crash the market? Remember back in 2008 when builders they were pulling permits like crazy, building houses and all that kind of stuff, and then the market was falling apart around them and they still were pumping out houses? Well, the same thing is starting to happen right now, not with the market falling, obviously, but I want to show you some stats today that are actually, they should be eye-opening. And right here, I'm going to start, since I'm physically in Nashville right now, let's start with Nashville. Let's start with the Nashville market. Let's take a look at it. Let's dive deep into some of these markets. I'm going to show you from a perspective of, if you're looking to be an investor, like where should we get in? How will these home builder permits that are going like crazy right now, how will they affect us as a real estate investor? Well, first and foremost, the stats that you're showing here right now, this is from Nick Early over at Reventure Consulting. They came up with a data point that I really, really like. What they were doing, instead of just like showing new permits that were pulled, they actually divide it by the total number of new jobs that were added, or total jobs that were available, I should say. And so you actually get a more realistic comparison to, should the housing market be growing or should it be shrinking? Obviously, if jobs are leaving an area, like what happened back in Detroit a little over a decade ago, if jobs are leaving the area, then naturally housing should be pulling back a little bit, new housing. But if jobs are growing in an area, then it makes sense that builders are building and all that kind of stuff. That's kind of pulls this together as a relative data point, rather than just kind of shooting from the hip and saying, hey, your area shouldn't be growing. Well, let's take a look at Nashville. So Nashville, this yellow dotted line right here, this is the long-term average, okay? The total permits by percentage of total jobs that are available is 1.7%. That's the long-term average. If we go back in time, back into like 2006, 2007, notice here, they had their run up in 2005. Well, yeah, 2005. They had their big run up, and then they had a crash like much of the market did. And ever since then, look at this. They have soared. They're upwards of almost 3%. Actually, they actually hit 3% for a little bit too. They upwards of 3% for new permits that are pulled for new construction. So they're more than double what they were back in 2005 is the point with this. Okay. Now let's take another market, Cape Coral, one that I'm involved in. Okay. Cape Coral, they had a surge in 2005. Remember, this is 2005, the big tip. And then they're down here. And it's funny because we often hear that Cape Coral is on the verge of collapse and all that kind of stuff. But if you look at it just strictly from a new construction standpoint, they're not overbuilding based on the number of jobs. The number of jobs that have moved into that area are really, really strong. Let me know in the comments if you'd like to see an area that you're considering investing in or you're investing in now, and we can look it up. Okay. We've got all the data. I got it right at my fingertips. I can go up and down. So you guys let me know in the comments, and then I can hit you with that data. Okay. Now we're seeing these sensational headlines out there right now. Headlines like this: builders struggling to meet demand for new homes. And a lot of it's true. If you dig into the meat of this article, what it's talking about is this particular builder, he's trying to build houses. He can't keep up. He's got a whole bunch of people that are leaving New Jersey, coming to this area. And there is truth to this argument. Okay. There's truth that right now, I actually have a hedge fund that I do some business with that literally, he showed me the data. He's acquiring raw land and then getting it ready for builders to build houses on. And he showed me the raw data on this. The raw data says that even if builders had infinite money and infinite labor, they could not keep up with the shortage of new houses that have to be built. And he explained, he said, well, the permit offices, for the most part, they closed for a couple of years in the middle of the pandemic. So there weren't these new housing. There weren't lots being subdivided. So right now, the new construction demand, it's massive. And there's truth in this case. So I've got a hedge fund client that I've done several hundred properties with over the years, and they're going all in on this, like building houses. They're not actually building the houses; they're getting the land ready. They're preparing lots to sell to builders, and then they exit the equation at that point. And his data, it looks totally accurate. And so for us as real estate investors, like, I just want you to know, like, when you're looking at these sensational headlines, there's sensational headlines on both sides of the fence right now. Hey, it's going to crash. They're overbuilding, all that kind of stuff. If I look at markets like, let's go into North Carolina. I'm going to show you this. It's going to look like they're way overbuilding right now. Durham, Greensboro, they've surpassed the last peak. I could go into like a Phoenix, Arizona. Phoenix has not surpassed the last peak yet. No, they're down still. They're actually doing much, much better compared to the number of jobs that are there. But I could go into more of these markets like this, like North Carolina, Charlotte. I know that they're surpassed the last peak. No, no, I was wrong. Okay, they're almost at the last peak right now, according to the number of jobs that are available. By just a sheer percentage of permits that are pulled, though, they have surpassed. So, anyways, when we're looking at all of this data, we can pull stats back and forth all day long. But the thing is this: even though there's a massive shortage in some regards, and then there's this other side of the equation that we're going to look at this. Like people are saying, oh, house sales could drop by 25% by the end of the summer. Both sides of the aisle are right in some regards. Real estate is a very specific thing to the location. It's not just this grand sweeping thing. Like if you look at the 2008 meltdown, 2005, we kind of peaked out in most zip codes. And then 2008, we kind of came down in most zip codes. Even if you look at that, if you look at the state of Texas, Texas didn't have a drop. Texas flatlined in some areas, but Texas still held its own during that whole era. And there were several other cities that held their own as well. So when we're looking at all these sensational headlines like, oh, they're overbuilding, it's going to crash. Oh, there's a shortage. There's too much demand. Interest rates keep climbing, and mortgage payments are up by over $400. Yes, yes, and yes, they all can be right. But the thing is that real estate is so specific to the area. It's so specific. What you need to do is protect yourself with cash flow right now. Regardless, like if you remember nothing else from this entire broadcast that I'm going to go through with you, if you remember nothing else, just remember to buy cash flow. Don't buy speculation. Not right now, not in this environment, not in a rate increase environment. Plus, some markets are maybe on the edge of their peak of price. You want cash flow. That's what my wife and I do right now. We look for cash flow properties, okay? Whether it be a vacation rental that cash flows, like we're picking one up right now in Greenville, South Carolina, or it happens to be a solid annual like apartment building where you've got multifamilies living in the same building and you're collecting rent. Whichever it is, just make sure that it's positively cash flowing from day one all the way till infinity and beyond, okay? Let's dive into some more of this, okay? So I'm seeing all over the place right now, a lot of analysts are saying, well, hey, housing prices are tumbling. And the reason that this is coming is because the leading indicators are saying it's coming, okay? Mortgage application rates have dropped. They're down by somewhere around 8% for primary houses. So that's a really big deal. Like when people stop applying for loans, it usually means they're not buying as much, okay? So you can look right here, you can go through this article and you can see that. I start to look at other leading indicators like let's start at the real beginning of the whole equation. Usually the first step into someone buying a house, even before they go to a mortgage broker, they call their realtor and say, hey, I want to go see that one. That's usually what happens. Sometimes they'll apply pre-approved and all that stuff first, but usually they're like, hey, I want to go see that one. And so this website right here, Showing Time, they're the national leader in collecting data on showings and properties. And they've compiled the data for at least the last couple of years, and they're pinning it right here. And I want to specifically look at this orange line. I don't really care about the two blue lines because those are the last couple of years. I want to look at what's happening real time. In real time right now, the showing requests, like people calling their realtor and going to look at properties, it's down. It's down. We're looking at Florida right here. I could go up. I could click on any area. Like I could click on North Carolina. Let's click on North Carolina, see what's happening. North Carolina had a pretty stark decrease in the middle part of March. Okay, pretty stark. Now they're starting to pick back up again. Life is coming. It's so interesting how real this data is too. Like my wife and I, we have a property in Florida right now listed for sale. Really, really nice property. And it had, when we first listed, it had strong showings. And then all of a sudden out of nowhere, right where you see this dip right here, if I go back to Florida, it'll be even more real time. But right where you see this dip, so we'll go back to Florida and then we'll look at it. This right here, we had nobody request showings, like zero. Okay. And now all of a sudden we're starting to get some showing requests and all that kind of stuff again. So this is the first leading indicator. I like looking at leading indicators as a gauge to what is going to happen. Okay. This is still crystal ball. It's speculation. No one really knows what's going to happen. But if you follow the steps of someone buying a property, it starts with showings, then it goes to the mortgage house to apply for a loan. So that's showings and then mortgage applications. And then next is actual contracts that are on properties. And then finally it's closings, actual sales. Okay. So these leading indicators will give us a clue of what could happen as we go into the future. Now, what I want to look at right now is the past. I want to go back in time to show you just a snapshot of history, because this is really where I draw my deepest conclusions. This gives me a clue of what's to come in the future, but it's still crystal ball. What I'm going to look at is the past, okay? I'm looking at two big things right now. You could certainly look at home prices for the last almost 100 years. Case-Shiller has been around and tracking housing data, and they've got the best data that's out there by far. There's not even a second comparison out there. Zillow's coming up, but Zillow's only like what, a 20-year-old company or so. Case-Shiller has all the data for the last almost 100 years. They compile it here. I like to look at this. Okay, we peaked out in most zip codes across the United States on average 2006. Okay, and then we had this crash. Notice that this crash, it's not like a stock market crash. It doesn't just happen overnight. It's not snap your fingers and all of a sudden, boom, half your IRA is gone like the stock market. That happened to me. I was a Target employee at the time. I had tons of money that I'd piled up with Target over time. And anyways, then my IRA that I'd built at Target working there as a corporate executive, boom, just got hammered. Okay. Real estate doesn't quite work like that. Okay. Real estate's more of a slow tumble. Okay. This is years because real estate moves much slower. So think of it like that. Okay. What I want to compare this to is the biggest catalyst of what is driving housing market prices right now. Okay. It's not the lack of supply. Yes, although the lack of supply helped elevate prices the last couple of years, but it's not the lack of supply that's driving prices right now. Okay. What it is this, it's the 30-year fixed mortgage rate. Interest rates are going up right now. In fact, by the end of this year, it depends on when you catch this broadcast, but by the end of this year, they're actually saying that we could hit 7%. 7%. That's extreme. I mean, that like we've already had 2 basis points, a 2% hike in the last like 4 months. And if we end up hitting 7% by the end of the year, that's so extreme. If I go back and I've really dug into this, I've looked at, this is the Fed, like their 30-year fixed mortgage rate, what it was during intervals of time. And I keep going back to look to say, hey, like, where was it? What did we hit? And then what happened after that? And if you go through this era of 2005, remember 2005, we were getting hot. The market was roaring red hot. It's even roaring more red hot right now in several zip codes across the country. But in 2005, so what they did is they started raising interest rates. They rose interest rates. 2005, they hit 6.23. And then all of a sudden in 2006, they had it at 6.72%. And then 2007, they had it at 6.69, 6.73. That appears to be about the peak during that time. What happened to real estate prices? Okay. So it was 2007. They hit 6.73. They started raising the rates. They hit 6.34 in 2004 to kind of cool it down. But in 2004, did that cool it down? Let's look at that. Okay. So let's look. 2004, did it cool down the market? You tell me. What do you think? Tell me in the comments. Let me know in the comments. Did it cool down the market? When they increased interest rates like that, did it cool down the market? Here's the market right here. Okay. I'll scroll down so you can see 2004. Did it cool down the market when they raised interest rates like that? Did it cool down the market? And the answer is no, it didn't. The market kept running. Okay. You can see it right here on your screen right now. The market kept running. And so consequently, they ended up having to come up even higher. They had to go stronger. They kind of flatlined for a little bit. You can see here in these intervals. Then they're like, okay, we're going to come up again. And you can see it dropped, like it went from 6.01 to 5.62. And like they played with it a little bit. Okay. It's kind of like if you're stuck in the mud, and that's kind of where the Fed is right now. They're stuck in the mud. They're stuck really, really bad. Just an FYI. They have terrible consequences to what they do and they don't do to monetary policy right now. Think about this. Since 2008, they've been printing money and pumping it into different sectors of the market. And they've never stopped doing that until now. That's like flying a plane up in the air and never landing for gas. It's never happened before. It's never happened in United States history before, what they've done for the last over a decade now. And now they have to. So they're stuck in a really bad spot. They're going to start selling off the assets that they've acquired over the last 12 to 14 years. They're going to start selling them off in mass sales. That's never had to happen because it's just craziness. They printed 40% of the supply of money in the last couple of years. They've got some dire things to deal with. And with inflation running the way that it is right now and housing prices still not quite curbing down, like they got some, like it's a tough decision no matter what they do on this. Okay. So, but if you look at history, even history shows us that even when they pumped the interest rate up a little bit, it didn't take effect on sales strongly. Sales kept running. And so my bet, this is speculation, this is just my thinking, is it's going to take a little time to cool down the housing market. Yes, some of the leading indicators, when people are shocked by seeing this new 6 or 7% interest rate, yeah, it's gonna hit them in the face and stuff will slow down temporarily, which is why we even saw like these showings. Look at these. I mean, the showings show us right here, this orange line. It showed us what happened in the market. The market's like, holy cow, interest rates just went up 2%. That makes my monthly payment drastically larger. And so the market said, okay, I'm going to hit the brakes on this. Okay. And if we go to states like, let's say North Carolina, what happened in North Carolina? Right here, same thing. They had a sharp curve down on showings. And then guess what? It's starting to come back again. Okay. So my prediction is it's going to take a little bit longer for these rates really to slow down the entire market. They're going to temporarily slow, but I think unless the Fed, I could be wrong because the Fed could buck me and they could just raise interest rates to 7% tomorrow for all I know. I mean, they've got a bigger lever than I have, obviously. And if they do that, then it could slow things down. But if you look at history says that even when the Fed rose rates last time, it didn't slow down the market right away. It took some time. It took, well, basically like 3 years before the market really slowed down. And then on the backside of that, then there was real tragedy for a lot of families across America because they ended up taking out interest rates that were unacceptable. They started getting into these bad loans. And mark my words on this. Mark my words on this. I bet with interest rates going as high as they are, banks and these mortgage brokers, they don't want to lose business. They want to stay in business. And because the monthly payments are so much higher right now, they're going to start with a 40-year mortgage. There will be 40-year mortgages. They will start doing crazy loans again. There will start to be more of like these 3-year one arms where you get into at this rate today, but then it goes up and it goes up. And there's going to be more craziness that has to happen because all of these people that are in the space of lending money, they can't just lend money irresponsibly. They have to look at the debt to income ratio of the borrower. And if there's an obvious gap where they can't make it, then they've got to get creative on the loan. So they're going to get creative on the loan, and then creativity often leads to irresponsible loans. That's what happened back in the last crash. Is there were a lot of homeowners that just took terrible loans, and then when interest rates when they peaked on them and then the values weren't there, then all of a sudden they had to let their house go into foreclosure. And you know the rest of the story, obviously. Okay. So will that happen again this time? There's a lot of factors that are so much different than last time. So I don't know. We're going to find out. Here's what I do know though. Okay. Right now is not a time to speculate. It's not a time to gamble because none of us know, not even the best real estate investors. I've been at this now for a long time. I've been actively, even while I worked my corporate job, I was still like, I basically worked a full-time job, real estate investing. I actually switched my shift as a corporate executive. I volunteered to work 4 10-hour days in a weekend. I volunteered to take a Sunday through Wednesday, 4 10-hour days. And I did that so that I could have the back half of my week to focus on real estate. And I did it for 2.5 days a week. And anyways, like I've been in this game now for a long time. I've been at this game for like 15 plus years. Anyways, right now I'm running harder than I've ever ran before. I'm going after it much harder than I ever have before because there's still tons of opportunity that's out there. But I'll tell you one thing that I'm doing very different than I did back in 2007, 2008, 2009. Right now, I'm buying pure cash flow. I want to make sure that if I lock into a property today, that it's going to cash flow long-term forever. Because when I get a property today that my monthly payments, let's just say $1,500 a month, and my rent is $2,000 per month, I'll just say one unit for simple comparison, and I'm making $500 per month cash flow on something like that. I know there's taxes, insurance, all that kind of stuff, but I'm just using easy estimated numbers here. Okay. But when I've got positive cash flow today, I know what's going to happen. Rents are going to increase. And if you don't believe me on that, look at my broadcast on what happens to rents during a recession. You can go back and catch that training. It's on this channel here, on this page here. You go back and catch that. I did that a few weeks ago. Rents during a recession, although real estate's geographic specific, you could have some downturns in some areas. For the most part, they end up holding their own and then eventually start to increase because as people lose their houses to foreclosure, then rents have to increase. Like it's just the way that it is. And so I'm buying cash flow today. If I can lock in at a positive cash flow position today on a 30-year fixed rate mortgage, then my rents are going to go up over time. They're going to go up over that 30-year period. I can guarantee you that. I cannot find a segment in history where I've ever seen them drop during a 30-year window. It's just never happened. And so while the rents are going up and the mortgage stays the same, I'm making more profit every single year. My ROI is going up. The tenant's paying off the mortgage for me. Like there's so many benefits to buying positively cash flowing real estate. So that's my focus for you. I would hate to see you try to speculate. I'd hate to see you get into crazy stuff like trying to build some big development and all that kind of stuff right now. there could be plays for it and it could make sense during specific areas and all that kind of stuff, but try to get good cash flow properties. I'll give you an example. Okay. This is one of our members actually sent this one to us. Great little property, Corpus Christi, Texas. If you're a Texas fan, this is a great deal. This is off market property, $200,000, rents for $1,700 per month. There's positive cash flow on this deal, even in Texas. Even in Texas, we can find positive cash flow because we hunt off market deals. Okay. Here's another one. This one is up in Milwaukee, Wisconsin. Simple little one here. All in for $70,000. It rents for $900 today. It could be rented for $1,300 per month. That's the market rent, but today it's got a tenant in there that's way underpaying. Needs a little bit of cleanup and all that kind of stuff to hit these peak rents, but $1,300 in Milwaukee, Wisconsin. Okay, these are positively cash flowing properties, and these are simple, little, easy ones. If you're thinking like, if you're like, well, hey Nate, I'm not into the single family houses, great, get multifamily properties. That's what my wife and I primarily go after. We take some vacation rentals as single family houses, but go take multifamily. We've got some of those as well. Okay. Whatever you're doing, go with positive cash flow, lock into long-term fixed debt and get positive cash flow. And it's going to be the savior for you. Okay. All of the clients that are running to me right now, asking for help and all that kind of stuff, like I steer them the same way. Positive cash flow, stick with positive cash flow. Don't speculate on stuff. Don't try to like get crazy and do these monster fix and flips and stuff right now. I know they're tempting. I know, don't get me wrong. They're very tempting, but positive cash flow will win in the end. Okay. I assure you that, regardless of what happens here, regardless if home builders build too much and tip us over, regardless if lenders get too crazy or the Fed gets too crazy and it tips the market over. If you get positive cash flow for the long haul, you will win in this game. If you want help finding off market deals, rental property specifically, we don't do any like homeowner stuff, but if you're looking for positive cash flow off market deals, then type in the chat below positive, and then my team will reach out to you. It'll be either a young lady named Katie or a young man named Gabriel. They'll reach out to you. They'll say hello. They'll start a conversation. We'll talk for 5 or 10 minutes. We'll see if we can help one another. If we can help, then we'll actually like start sending you properties and all that kind of stuff. If we can't help, we'll certainly refer you to whoever we can that can help you in the industry. So if you want our team's help getting off market positive cash flow deals, then type in the chat below positive, POSITIVE, positive cash flow. Okay, guys. Thank you very much. God bless. I got an event here in Nashville. That's why I'm physically here. So I got to go get ready for it. I appreciate you. We'll see you soon. Bye-bye.